All right, we are live.
Hey, well, good afternoon and welcome to the Financial Health for Tribal Producers. This is Managing Your Money Part 1. This is using my MyFi Assist app. We just completed the first one, is developing a strong foundation, and we're moving into the next one. This is funded by the Western Center for Risk Management Education out of the grant with the award that you see below from the United States Department of Ag, National Institute of Food and Ag. And the team that we're working with, Dr. Ward, she'll be the lead and discussing and going over the MyFi app on this session. I'm Trent Tickerstrom from the University of Arizona. We have Vicki Hebb, University of Nevada, Reno, and we have Juan Arias, the University of Arizona as well.
Hello. So this is going to go through, and it builds upon what we just talked about with, but it can really be used for both your family or for your business. It's really just to take the mystery and the math and everything from loans and interest rates and all of those things out of it and just put you in more control. And that's so that with Trent, we created an app called MyFi Assist, and it's just been updated. And so, in fact, there may be some bugs in the update that we'll have to find over the next couple of weeks and continue to do some updates, but we're going to go over that. But before we get into the app, I think it's important to kind of understand what an interest rate is, because a lot of times we just think that it's there, but we don't really know where it comes from. And by knowing where it comes from, I think it helps us a little bit. So I've explained this different ways, but the best way that I think to explain it is to really kind of talk about the individual components. And it might seem weird, but if you want to buy a soda, you have, if I was in a movie theater, it's going to cost me $3 to $4. If I'm at a gas station, you can buy one for probably like $1.20. At a grocery store, they might be even cheaper. And if I wait till it's on sale at a grocery store, you can get it for 30 cents or even less. Like sometimes they have the 12 packs for only like $2.50, $3 a piece. And so if you think about an individual soda for that, it's only like 20, 30 cents for one. So if I can wait and get it for 30 cents, why am I spending $3 to $4 at the movie theater? If I just waited till the movie was over and went to the gas station next door, I would save myself a couple dollars, but there's a reason why we're paying more of this. And the reason is you wanted it now. We don't want to wait. And so if you're going to wait, you need to be compensated for, if you're going to wait to use your money, you need to be compensated. And so that's just like part of our interest rate. You're willing to pay more to have that money now instead of waiting to have it after you've saved up for it. So in order for the bank to give you the money now, you have to pay them something for this time factor. And or if somebody else is going to use your money, then you want to be compensated for that, and you want some extra money for you not being able to use it right now. And so these are the three components of the interest rate. And the first one we've already talked about was time. So just the pure fact that we want things now versus waiting. So we've either got to pay somebody to use their money, or they're going to have to pay us to use our money. The other two are inflation and risk, and we're going to go over those a little bit. But time and inflation are the same for everybody. It's the risk component is the factor that makes one person's interest larger or smaller than another person's interest. And so as we get further into the presentation, we'll show you some examples of how those interest rates can vary. But just in the back of your mind, it's good to remember that it's because of the risk. The risk is really what's going to cause that rate to vary between people. Time and inflation are what causes them to, everybody faces the same thing. And so here, so we have already really talked about the time, so we know that component. And then inflation is the second component. And I think a good way to think about inflation is to start out with that idea, when I was your age, and I'm sure we've heard about that different things. A candy bar cost 5 cents. My parents used to say, I paid a nickel for a candy bar. And, but was that candy more or less expensive when they were doing that? Just looking at the price would say it's less expensive because I haven't been able to buy a candy bar for a nickel anywhere. However, because of inflation, it makes it difficult to tell, because inflation just means that over time, that money, it takes more and more dollars, physical dollar bills, to buy the same amount of stuff. And so some things have become more expensive faster than what inflation would say, while others can be slower. And so they've actually gotten cheaper over time. So to find the value of something in today's dollars, there's a great inflation calculator available from the Bureau of Labor Statistics. And so if you go to, it's hard to remember where the inflation calculator is, but if you go to BLS for Bureau of Labor Statistics.gov, and then just on their website, search for inflation calculator, it'll come right up. And I'm going to show you it in the next slide. So this is what it's going to look like. So it's really simple to use, but you can put in an amount in the top and say in what year that was. So I could put in my candy bar for a nickel, and then it's going to tell me in another year what the value of it is for inflation. And so this can actually be something that's kind of fun to do with a family with multiple generations when you're together, you know, like over a holiday or something. Like after Thanksgiving, you know, you've eaten the turkey, you're sitting around, you're kind of half falling asleep. You've got lots of generations there. I think this is a fun thing that you can do. Because you can start to ask like your elders. Go ahead.
Well, yeah, this would be a great thing. And I was just thinking of trying to get to multiple generations of that family support group that we talked about at the last one, and getting them all on the same page by all having an understanding of where they're at financially and what the current currency is overall, instead of multiple generations.
Yeah, and so so this is fun. Ask them what their first job, how much they made in their first job and what year it was. If they had a loan payment or they bought a car, you know, things like that. It's kind of fun to see how that's changed over time. So if you delay the use of your money, it's going to buy less in the future. You need to be compensated for it. So inflation, remember, we're talking about all of these things because it's the interest rate. So inflation is another component of that interest rate. And so I did the candy bar example in 1950. The nickel there was 49 cents. It's been a few years since I did a screenshot of this, so I didn't do it for 2020. But actually, candy bars aren't normally 49 cents. And so the candy bars actually gotten a little bit more expensive. So, but you can try different things, and it's kind of fun. This was in 2000. I can't even remember what this, I bought 515 in 2000, but in 2016, it was $7.09. So it's really a matter of, you can do kind of any amount that you want for any year. And it goes back, I think, to 1912, 1913, up through 2020. So we talked about time and inflation were the components of an interest rate that were the same for everybody. And that's why we can use like an inflation calculator or something. But risk is something that's more individual. And the bigger the risk, the chance of somebody not repaying you, the bigger the payout should be. So you need to be compensated for having that extra risk. And so through lending, so this can happen, the way this happens with lending is through the interest rate. And so if you're a bigger risk, the bank may charge you a higher interest rate if they lend money to you. And we've seen this. And so here, I think that same example back of the payday loan, this is, I think, the most extreme example that I've ever seen. And this happened to be in Utah. A payday loan company charged 522% as an annual percentage rate for a loan. So they paid $10 in interest for $100 for a 7-day loan. That $10 in interest is the same for 7 days as it would be like a 10% loan for a whole year. And so really that is really high. And they actually had one situation where it was $50 on a $100 loan for 7 days. So they had to pay half the loan amount just to have it for those 7 days. And part of those were fees. So they weren't saying that they were all interest, but they really were the interest and fees and the cost of having that money. And so sometimes we can get in traps of this where I want it right now, it's really convenient and stuff, but we need to kind of watch about it. But payday loans, really risky, and they charge you a lot of interest just for, but I think people don't realize how much interest they're truly paying. Another measure of a risk is a credit score. I think we've all heard of credit scores. And there's places to check your credit score. We're not going to get into all the details today because we don't have time. But if this topic is something that you would like to get into more details we can even arrange like individual webinars or something that we work with your individual, maybe like tribe, or something we can do. You can also work with your FERTAP agent or come back to us for questions too. So these are just some examples from Arizona. And the thing to note is this differences. So a really high credit score, the interest rate on this 5-year auto loan was 3.6%. And a lower credit score, we had like a 17% difference. And that seems really high, but I deal with money and I deal with the calculations a lot, but it's still in my mind, it's really hard for me to really kind of calculate what that means. And so the app and the rest of the presentation is really going to help us put those into perspective to say, what does this really mean? And to help us kind of have more of that control. So here is the app. It's called MyFi Assist. It may also be USU for Utah State University MyFi Assist, but that is the icon that you'll see it with. And it's available for free. It's on iOS and Google Play. We are in the process. It's been updated on iOS. It's in the process of being updated on Google Play. So I think there may be one or two different versions in the App Store, but we're working on that, and that should be there over the next week or two. If you have questions, come back to us. More information on the app and materials can be available at this website, diverseag.org/money. So here's the app, and as you go into it, whoops, it's taken me, I am just going to stop sharing my screen because, well, we'll see if it keeps going. But it started just wanting to, oh, yep, I'm going to stop this so that I can get rid of some animation issues. And then we will come back to it. But we're going to show you how to, sorry. Tell them a little bit about the app, Trent, while I get rid of this.
Yeah. So what we designed this for is, as we talked about in our first session there, with the importance of interest rate and working for you and working against you. And but not everybody understands, like Ruby was mentioning up front, about what is it and why is it so different. So what we want to do with this app is make it more personal. So something that is personal to you in the ranching community is, as you'll see in some of our examples, is how many calves you produce and sell, right? How many you have available to sell. We've done, you can put in hay. If you're working with your kids, you could put in, if they're into that, video games and babysitting hours. It gives you that thing, that trade-off thing. And now that's up, we'll run through an example, but that's what it is try to make that interest more personal to you so you can see the impact of it on something that you truly care about.
So in this case, so this is where we have this preferences. And so you put in your item and you put the value of that item. We're going to use calves, and we're valuing them at $500 a head right now. Hours worked could be another example.
Put anything you want that's important to you in there that you spend money on, right? Or you sell or you buy stuff.
I've done this with youth presentations over time, and I've done energy drinks. And we put in that, and so how much they could have, in the terms of how much that car would cost them in terms of energy drinks that they're paying for. So it's just really kind of whatever you want. So we're going to look at you buying a truck for $30,000. The interest rate on the loan is going to be 6%. There's no down payment. We plan to pay it off in 4 years. And so there's various things that you can do in the app, but one of them is paying for a loan. So if you pick paying for a loan, this is the screen that pops up. And you'll want to populate these top boxes and then hit calculate, and it'll populate this latter half. And so we put in 6 for the interest rate, the 4 years that we're going to take to pay it off. How much do you owe, or does the item cost? That's that $30,000 for the truck. And the amount of your down payment, if any. We're not going to do a down payment. I hit calculate, and then this all pops up for me. And so I think I've got a bigger one on the next slide. Yeah, so here's just that bottom half. So our monthly payment is going to be $705. And the fun part with this is that this you will need section down here at the bottom puts it in terms of whatever we said was our item. And so in this case, we said cabs was our item at $500 a piece. So that payment is the same as 1.4 cabs each month, or 17 cabs each year, 16.9, but that's 17 cabs each year. And so then you can ask yourself, what is buying this truck worth me having 17 cabs to just make the payments on this? Where am I going to get the 17 cabs? Is this going to, be worth it for me? And so we talked about the wants versus need, or trade-offs, you know what I mean, in the last presentation. And so this just kind of helps you put it in terms that you might be able to think of differently. Is this trade-off of 17 cabs versus the truck, is that a good trade-off for me? And we'll look at some other things and stuff, but I think that over time, it'll also tell you that you're paying 13% extra for the interest. And that, remember, came from the time, the inflation, and the risk and stuff. So it gives you a lot of information. And if you want to change this something and say, well, what if I only bought a $20,000 truck, or $15,000, or what if I paid it off over a different number of years? It's really easy to change those boxes and get new answers. And so the reason we have this is being informed of your options is the most important component, I think, of making decisions. And a lot of times for these financial decisions, because there's a math component involved and some other types of things, I think we feel like we're not really in control. We also can be pulled into the sales hype. Has a salesman ever been your best friend? Oh, I just love hanging out with you, Ruby. You're just so fun. Oh, I'm just so excited that you're going to be able to get this truck. And so don't be fooled by that, because, they really can be, they're there to be your salesman and stuff. And so you can get sucked into that. New versus used. Is this something that it's worth you having the new option versus the used option? And that may be difficult to kind of think about until you maybe put it in terms of like how many extra cabs you're going to have to sell, or other types of things. And then it's easier to make that decision. Think about not just this decision, but the potential effects on other decisions. So a lot of times that comes back to that idea that we were talking about in the previous webinar of the trade-offs, you know what I mean? And so if you're spending more on one, then you have less money to spend down the road for other types of things. And so it's just kind of a continuation of that same thing, but this way we can put that a little bit more into control, because the app's going to do the math for you. So I did another example of borrowing a truck for $20,000. And I pulled some different interest rates off, and you can see a little bit different than the ones that we had on the previous slide, but pretty similar in the range. You know what I mean? The spread before was like 3.5 to 17. So this is a little bit higher. And so for that $20,000 truck, the monthly payment is going to vary between $454 a month up to $600 a month, depending on that risk factor of how they're perceiving, and they're using your credit score for that risk factor. In agriculture loans, they don't always use the credit score. A lot of times it comes back to that relationship with the banker and how stable they think you are, your credit history of having borrowed and paid off those loans before, different things like that. But for the purpose of us just illustrating the difference in those interest rates and what effect they can have on you, I think the credit score interest rates, that we're using those as a good example. But remember that that may not exactly play into what an ag loan would do.
Yeah, that's a good point, Ruby, because I know we've had some discussions with our folks, or FSA folks in Arizona and everything. They said they don't use the credit score necessarily. They really rely on the relationship they have with the producers. and it's important because they understand the producers then. And so it does make a difference, and I'm glad you pointed that out.
And FSA, I think that Vicki also talked about having a good relationship with your FSA and that, but they actually have some loans with even lower interest rates than what I'm showing on here for the best credit score. But sometimes it takes a little bit longer to get them set up, and they have some different terms that are sometimes meaning that how fast you have to pay the loan back and other types of things. But it may be worth looking at for you, because if you can get a lower interest rate, that can save you quite a bit of money. For just this $20,000 truck, the difference here is $150 a month. And that seems like a lot, and that seems significant, but I think it's hard for me to kind of put that in perspective again in my mind. And so I also did it per year. And so per year, that's almost $2,000 difference that you're going to, because of your interest rate at the most extreme. And then on this next slide, I put it in terms of head of calves. So again, that app, when we do each one of these lines would be a different, set of those 4 boxes that we put the information in for. But then it would come down at the bottom that you need 5.5 calves if your interest rate is 4.3%, but if it's 19%, you'd need 7.2 calves. That's 32% more calves with bad credit. And it may not be that you can get yourself to the highest credit score, but maybe if we can do something where we can get ourselves, get a little bit better and get perceived as a little bit less risky, that can make a difference over time for a lot of things. Because this is just one pickup loan, but it's 32% more cabs that it takes to just buy the same thing if you have that extra risk.
And I think it's also important to point out on your operation, if you're looking at this, is can you do that? Remember, these are additional cabs, or these cabs have to come from somewhere. Can your herd support that? Can your health system support that? You need to think about that overall when you go in and talk to that salesman, the new versus used, and what is it you really need on there. Think about how that impacts on your herd. Can you do those extra calves? Can you afford that? What else are trade-offs?
And the good thing about the app is you could actually start calculating these things before you ever go see a salesman, right? So you could put in some different situations and say, knowing that I have this, is that something that I could do? So this is for the whole loan. And the reason I brought this one up is because for the whole loan, it could be almost 2 calves versus almost 9 calves just for the interest part. So that's in addition to paying for the item that we're borrowing money for, but we're going to have to pay an additional 2 calves up to 9 calves, depending on our risk. So that's why it's good to, all of these things are things that we can work on, you know what I mean? And you're not going to do it overnight, but it's worth paying attention to there. It's worth seeing what can make me, or like I said, go with the FSA loans and stuff that can have a lower interest rate. So here's another example that I threw in here just to kind of see how extreme some of this stuff can be. This is how long will it take to pay off my debt? This is another one of the screens that we can use in the app. There's 5 different types of calculations it makes. And what's the annual interest rate? And this would be on like a credit card. So 12. What's the balance today? So you owe $1,800 and you're going to pay $25 a month. And this is probably about like the minimum payments. And then you'd hit calculate. And if I do that, so basically with a $25 minimum payment, it would take me 128 months and almost $1,400 in interest on that original $1,800 that I'm paying to pay that credit card off. If I paid $75 a month instead of the $25, it would take me 28 months to pay it off and only $269 in interest. And so again, we're going to just use the app to give you that control to calculate the situations, and then you can make the best decision for your situation.
And I think this also goes back using this MyFi app. Remember, we talked about setting the goals, some of the achievable goals in that first part, in part 1 of this. And this can help you do that. Paying off some of your credit cards is one of those goals you can run through this app to see how much you need to do and get a better sense of what time it is, how much you could do, and kind of get those metrics so you can be able to achieve those goals that you were targeting.
So the interest rate on a credit card and how the amount paid each month determine how long it's going to pay it off. And so the one that on the app, it's the payoff credit card. I did $1,200 owed and made $50 monthly payments. And we could do various interest rates. And so let's see, I should have that. Yeah. So here's just to have an idea of just how much, again, that interest rate makes things vary. So we're going to pay off the same $1,200 on that credit card. We're paying $50 each month, but this is saying that with different interest rates, you're going to have to work more hours. And so the reason I bring this up is because sometimes you see two people in very similar situations with the same job that they have, the same other things, but one just seems to always, you know what I mean, have a little bit more in their lifestyle than the other one. Partly that could be if they're borrowing a lot on credit, this is going to catch up to them. But partly it could be that if they've gotten, if you're paying a lot more just on interest, or you're borrowing a lot more of that money on the credit card and then paying it back, you have to work extra hours to pay that credit card back. And so that $1,200, if I made $12 an hour, that's 100 hours that I'd have to work to pay the credit, buy that stuff if I bought it just with cash. But I have to work 6 more hours if I have a 5%, 12 hours if I have 10%. And a lot of credit cards are more like this one. So that means you've got to work an extra 29 hours to buy the same things as you would have bought with the cash. And so I think that's just another way to put it in perspective of helping you as you plan. Is this part of my trade-off? You know, do I want to work that extra 29 hours and have it now versus waiting and saving for it? And so it just kind of lets you have that control. And I did an extreme, let's see. And then I think this is where I just did the high interest rate, but we made the minimum payments, and that kicked it up to 97 months. So almost tripled the months it would take to pay it back and doubled the amount of hours that you'd have to work. And so that's just so sometimes you can get into a trap, not as severe as the payday loan example that we showed in the last time, but sometimes these credit cards, you know, having the balance on and just making the minimum payment can really kind of put you into a situation where you're making that minimum payment for a long, long time. We lowered it just by $4 a month, and that again doubled the number of hours, or brought you another 122 hours to work, and it doubled the amount of months that you'd have to pay that. It can also be used to look at home loans. The interest rate on a home loan does not vary as much as the interest rate on the auto loans. Partly this is because houses would have collateral. I know in some of the tribal situations, because of the trust lands and the tribal lands and stuff, you may not, that it can work a little bit different. So I just wanted to show that we can use paying for a loan for more than just a vehicle expense. Any type of loan, we can really put that in there and use it. This could also be equipment loans for like a cattle operation or something else. And if I have a loan, even though this says pay off a credit card, if you have a home loan or you have another type of loan, you can also look at how much increasing your payments would reduce the amount of time to pay it off. And so there's various ways that you can use this, but it's just really meant to give you more control. And so we've gone through these fairly quick. So if you have questions, don't forget to put those in the chat box or to put those on Facebook, and we'll look at those. But the take-home message really is that lower credit scores or lower risk means a lower credit score or higher risk means a higher interest rate. If you're perceived to be more risky by your lender, you're going to have a higher interest rate. Higher interest rates mean borrowing will cost you more. You're going to have to work more hours to pay for something, you're also it's going to take more cabs, or you're going to have to sell more hay or something like that. If you make smaller credit card payments, it's going to take you longer to pay that balance off, and you'll end up paying a lot more. These are things that you probably have thought about or think or know, but by being able to use the app, it can put the actual numbers there, and you can make the best decision for yourself, because it's really just about giving you more control and making it easy. Sometimes if I want to look at situations, I don't want to go through all of the math, or the math might slow me down. So the app does all the math for you. You just have to touch the button. And so I think that is it. Do we have any questions or other topics that we want to bring up?
I know one of the questions that I get a lot is that, well, is the goal, you know, if I'm debt free, if my goal is to be debt free and everything, and I get all this, then I don't care about my credit score, which is true, right? I mean, if you can pay everything in cash, he has a credit score of 0. We're not talking about that yet. We're talking about trying to get you down, working towards that kind of stuff, to where you can get to that business that you want to start. But so when you hear those folks talk about that, yeah, that'd be nice when you're paying, if everything's paid off and you don't have that. That's part of the goal on these things. But it's also for that business to move. So you want the lower impact on there, and you're setting your goals like we talked about earlier. And you use this app to try to help you set those goals, and what are manageable, what's doable, and what's not. And then is it gives you a better time frame too, I think, of when you can do some of these achievable goals. But yeah, just wanted to throw that up, because I've heard it a lot. Well, if I don't know any money, anybody, anything, and I don't care if my credit score is 0, which that is absolutely true. And that's not a bad goal to get, but you're gonna have to get there. Yeah. And there's that buffer between when you're paying stuff off and when you need it, relative to when you have nothing, that you gotta be aware of. But
yeah, I think also I wanted to make people aware of the spread, because of how that perceived risk is in the interest rates. Because a lot of times when we're talking about a business, or like starting a livestock operation, or you're something like that, or having one, sometimes the financing is a necessary part of that. And if we're paying those really high rates of interest, it makes it very, very, very difficult to make that operation break even or make it profitable. And so being able to, start to push that in the other direction, so that our interest rate isn't so high, can make that operation more profitable, make the bar to get it to be profitable more achievable. And I think that's important in looking at things.
Vicki, I think you've seen this with a lot of the producers you worked with too. They're moving through there, and when they take some of these on.
Yeah, and another point on this is that equally so, if you don't borrow any money, you don't get any credit. And so, moving into looking at starting a livestock operation, you have to look if you've ever, borrowed any, because that's part of this process too, is establishing credit.
Yep.
And it's really important, once you find that credit, to use an app like this that is so handy, so you understand, going back to that new pickup versus the used one, so what your calf payment or your cow payment's going to be based on your calf check, and can you add in another expense such as pickup, and the deflation of the pickup as soon as you drive it right off the lot. So that's kind of the purpose of using an app like this, so that you can immediately see and educate yourself without relying on someone that's trying to sell you that pickup.
Yeah.
I know when I've gone to like an equipment dealer or a car, a car dealer, a lot of times they don't even tell you how much you're paying for it. They just say, well, your payment's only going to be this much per month. Your payment's going to be this much per month. And they haven't let you know what the interest rate is, and they haven't told you how long, and the way they're sometimes getting that payment lower is they spread out the number of years that you're paying it back over. And so if so sometimes you can get into something where I've seen people say, well, they said it was only this much per month, but they put it on like a 7-year auto loan, and the vehicle was trashed, before they ever got it paid off. They ended up owing more on it than it was worth. And you start doing that, it can really be hard to pull yourself back out of situations like that.
And it's very important from the get-go to be aware of that. We just had a young girl that went and got a vehicle, you know, very high interest, hit a deer, they totaled it, and now she's starting off her credit owing $4,000 on a vehicle she can't drive and has to figure out how to buy another vehicle. So it is very important that you look at the whole number, not just what they're telling you in order for you to buy it, because it's what we call it, you'll be upside down going into your next payment. And what they do on that is they just add it on to the next loan, and your payment gets higher, your interest rate gets higher, the length of time, you know, is long. You're digging a hole that's very difficult to get out of.
Yeah.
Yeah, and this can be used in concurrent with the cash flow sheet that we were talking about earlier, to add it to your list.
Yep. Yep. You want any tool possible to help you achieve your goals. And this is one of those, not just on achieving it, but, you know, actually defining it. So you have it measurable, because we want it measurable. And this does that. It puts that timeline on it, and it does the measure. Yeah, you're going to add more, $5 more a month, 10 more a month, make a double payment, those kind of things.
Good.
Unmute myself. So these webinars are going to be available as recordings on the Facebook page, and then also we'll put them on the Arizona Tribal Extension website. And today's were about really kind of managing your money, building a strong foundation, and using the app as one of the tools to do that. And then next week, at the same time, we're going to have Building Your Business Foundation Part 1 and 2, and that's going to go over the 10 basic questions that every livestock operation should consider, and then some into financial analysis. And so it'll build on what we did here, but really kind of then start looking at it from a business operations standpoint. Then we're going to give you a break for a month or so that you can get your stuff put together and have time to put your plans together and get your questions and stuff all assembled. And then this fall, I believe in September, we're going to do Moving Forward with Your Business Part 1 and 2. And that'll be putting your plan to work and putting it all together. And so it's really, and then we'll have all these recordings and stuff too. So it's really just about kind of bringing all this information together to make you stronger financially, stronger as a family, and stronger as a business.
Yep.
And also to ease this process. This can seem very daunting to someone starting out. So we're trying to do this in small steps, so at the end, you have more information than you ever thought you could, but without getting completely stressed out. A lot of times when we're starting something new, it seems completely overwhelming, and so we just never get started. Well, that's what we need to avoid within our tribal producers, our tribes right now. It is so important for us to start businesses and to start building this economy going forward. So we are really trying our best to make this as simple and user-friendly as possible.
So feel free to reach out to any of us, reach out to your FERTEP agent. They know how to get a hold of all of us. And if there are certain topics that you'd like to see that we haven't covered, or as a follow-up or separate, let your FERTEP agents know or let us know, and we'll see what we can do, and we can schedule other events.
Okay, more questions?
Yep. Any questions?
No questions.
All right. Well, we thank you guys for being on with us today and look forward to seeing you next week.
All right. Thank you.
All right.